And we welcome you into another week of Scrushy on Business. I'm Dave Green, joined as always by Mr. Richard Scrushy. Richard, how are you doing this week, sir?
Well, we're doing good. We're doing good. Sun's out, shining. Ice has melted away. How about you guys? I know y'all really been hit hard up there in St. Louis.
Yeah, we were, but I think today is the last day below freezing, at least for a while. So we're going to have some 40s and 50s, maybe even see 60s here in a bit. So I'm guessing it's going to be melted away here soon. But yeah, it has wreaked havoc on this region. And of course, it has been this way all over the country for the most part, and especially in some crazy places like Nashville and things that aren't used to getting this kind of weather.
Yeah, and it shut business down. And I saw where FedEx had shut down. They were unable to deliver packages, and they temporarily closed a bunch of offices, and everybody kind of got messed up. Had to move all their appointments and businesses. So I know it's an expensive thing, isn't it? I mean, it really does. It cost everybody money, and you saw what happened to the airlines. They were losing hundreds of millions of dollars with
Yeah.
the shutdowns. Yeah.
It's people don't think about it if they're not in a business where the weather can really affect you. I used to run with somebody who was in the golf business, and
Hmm.
he would talk about not just the bad weather, but when the weather report was bad, and
Yeah.
how that would affect their business
Oh yeah.
just in the forecast. And so to them, and I'm the furthest from a meteorologist, but a 30% chance of rain, right? To you and me sounds like 70% chance it's not going to rain. But
Hmm.
to a golfer who is looking at a week and sees that it might rain on that day, that can really affect their decision. So some businesses are just absolutely brutalized by weather, but it really is crazy when you stop to think about what the impact can be. Here, of course, in St. Louis, we always talk about the weather panic button, right? You got to run to the grocery store, and I call it, you get your French toast ingredients, right? You got to get your bread, your eggs, and your milk. And the grocery stores just get crushed during
Oh,
that
horrible.
period. It's just it's amazing how it affects business.
About 3 days before the hit, I just happened to go to Walmart, and my daughter had said, Dad, we probably might want to pick up some water. And I went, and they didn't have any. It had all the water was gone. And so, I live out in the country. We have a well, so it's actually better than drinking the bottled water. So I told her we're drinking out of the well this week. Don't worry about it. It's
Yeah.
no big deal. But yeah, well, hey, just to get started, we have spent a lot of time talking about venture capital, about funding businesses, raising money, and different things. I know we always have a lot of questions about that, and I wanted to dig a little bit deeper and if we could, and just talk about some specifics because people are always asking, what is the investor really looking for? And, I've talked a lot about that. Your management team, we've talked about that. We've talked about being able to scale. We've talked about, being able to prove that you got customers, doing your numbers, showing multiple years of projections and, what it's, how much it's going to generate, where the customers come from. And, is it a local business? Can you build it into a national business? But let me dig. Can I just jump into this? I want to dig a little
Please.
bit deeper. And they're looking for real payers, real customers. They want to know that they're going to have real customers. There is a great thing right now that I saw. It's on the internet, and it talks about Sears and Roebuck. And I grew up with a situation where my dad worked for NCR, which used to be National Cash Register. And there for a long time, National Cash Register dominated the industry. If you went into any store anywhere, there was an NCR, a National Cash Register machine there that they would ring up your product on, and it would print out, and the drawer would open, and you'd pay cash because we didn't scan credit cards back then. You were either writing a check or you were paying cash, and it had the little drawers and. They'd take the $100 bills and stick them up under the drawer. So, it didn't look like they had a bunch of money in there. But anyways, and then NCR, there was a time when NCR had a situation where the board met, and the computers were kind of a up and coming thing, and they made a decision. They didn't think computers were going to last, and they didn't get into the computer business. And of course, guess what? IBM slipped in behind them, started building computers, and then NCR was behind the curve. Then they started building, their tower computers to try and get into that business, but they were always behind the curve. And IBM built an incredible business. And so a similarity, and of course NCR then went on. And I noticed back a few years ago that NCR had the scanners at the Walmarts. Now I noticed that there's another company that is doing it. So I guess NCR lost that business. I'm not really sure what happened, but anyway, it's interesting to watch these companies and how the board of directors and how the leadership will make decisions that will destroy the company. And let me give you a perfect example. And watching this Sears and Roebuck thing that's on the internet right now, and it talked about, back when they built the Sears Tower in Chicago, they were basically saying, "Hey, we're the biggest and the best," right? They built a 110-story building. I've been up in the Sears Tower. I've eaten up there. I've made presentations to investors up there. It's just, it's an awesome building. But at some point in the 90s, Sears and Roebuck got into the real estate business. They started selling insurance. They had Allstate. They had they were doing some banking business. They were doing all kinds of different things. Car insurance, and with Allstate and all these different things, all these different businesses that they had gotten into, and they forgot about the customer that was buying the drill bit or was buying something simple or buying some socks or some shoes or whatever. And they started focusing on all these other things, and their stores began to change. And I remember years ago, I walked into a Sears and Roebuck, and I thought I was never going to be able to check out. It took forever to get through. They had to read all these numbers and put them in and all this manual stuff, and I'm standing in line. There are people behind me, and I just had a few items, and I made a decision. I wasn't going to go back there and buy anything. And I think everybody began to do that, and of course, they made a tragic mistake that, and this story on the internet was just phenomenal. They talked about the fact that when they had the Sears catalog, this was way before Jeff Bezos and before Amazon, everybody bought. I remember my mama buying clothes and it coming in the mail that she ordered off of the Sears Roebuck catalog. Well, they had the Amazon model in the Sears and Roebuck catalog, but some brilliant leadership at Sears made a decision that was outdated. They weren't going to do it anymore, and they closed the catalog division, shut it down, and quit. So people could not order. They couldn't, because it was a dream book. And when we were kids, we'd flip through it and buy, "Mom, I want this for Christmas or my birthday." And, people bought off of that. They'd pick out the shoes they wanted and the shirts and things, So they were the beginning of Amazon, and they shut that down. Somebody in the top tower that was probably overpaid no longer it wasn't Mr. Sears who had the visions. It was somebody else who was not an entrepreneur and did not have the ability to see the world as it really was and what was coming. And what was coming was, Jeff Bezos saw it. So,
Right.
in other words, Sears and Roebuck could have been Amazon. And, long story short, they missed it. So when we start thinking about, I think about when I was building Health South, the reason that Health South flourished so much is that there was a change. When back in 1983, there was a change in the reimbursement to hospitals, and it incentivized building outpatient centers because they took the ancillary profits out of hospitals, and they decided, they were going to pay on a diagnosis, and they went to diagnostic related groupings. And when they did that, it created a bubble opportunity to go out here and build cost-effective outpatient centers that patients that didn't need to be in the hospital but could get the services done here. And the hospital industry kind of missed that, and that it's kind of a similar thing. And that allowed us to build a national company, international company actually, but national to fill in that gap and what the opportunity created. So when I'm sitting here and I'm thinking about venture capital today and what the venture capitalists are looking for and the things. I want to dig a little deeper today. With all of that being said, clear metrics that show that, what is the real revenue opportunity? Okay, what is it really? And then something that shows how your customers, are we going to have repeat business, or we're going to have one-time customers? Because if you have repeat business like McDonald's, people coming in almost daily, weekly, then you can just keep building, and you get new customers to come in with new promotions. So, do you have any pilot? Can you do a pilot contract? In other words, to be able to prove to the investor that what you're going to do and what you're going to sell and whatever your service or business or product is that, here's a pilot thing that we did over here, and these people bought it and used it and loved it, and here are the results of that. And that would help show kind of the reducing of the risk if an investor, comes in and makes an investment. So, those things that you can do like that to be able to show that, we can do this. But leadership, we talk about leadership under pressure. So when you come in to speak and they start asking you a bunch of questions, how do you handle yourself? Are you smooth? Are you calm? Can you present it? Do you know your business? Do you get tripped up? Do you want to argue with them? Oh no, you don't. No, no, anyhow, you got to be careful how you present, especially to sophisticated investors. And I've said in so many meetings with people that manage billions of dollars, they don't have to give you any money. They don't care. But if you really got something and you present it right, they get pretty excited. But there's some terms that I think are important, like a capital efficiency. Now, and behind the scenes, when you make your presentation, this kind of stuff venture capitalists or fund managers will talk about. They want a longer runway. In other words, they want to be able to put this much money in, and they want it to last longer. So they're gonna be talking behind the scenes, maybe not so much with you, and they're going to say, "I wonder what the runway is here. What is the capital efficiency? How long is the runway?" And then and then they're going to get into something that they call signal to burn ratio. Okay, signal to burn. Now, signal's going to be your denominator, and your burn rate's going to be. Signal's going to be your numerator, and your burn rate's going to be your denominator. So the higher this number is, in other words, the higher the numerator is, the less risk there is. And what that's saying is, when we put this money in here, it's going to have a longer runway. It's going to last longer. And so it's going to eliminate and reduce the risk of investing in this. So in your mind, and when our listeners are out there right now, when you're thinking about presenting to whoever the investor might be, whether it's angel investors, whether it's a wealthy, whoever it is, whether it's a fund manager, it's venture capital, traditional venture capital, whatever it is, institutional money, even if it's a public company, you need to be able to present that signal to burn to them and help them understand that, we put in this much money and we have this much burn. So the higher the numerator is in that fraction, then the more attractive it is to the investor. And so, you know what that says? When you have a high numerator, it says that there is a demand, what we call a product to market demand. Okay, so the market is demanding that product, because if the market's demanding the product, guess what? You're going to have a lower denominator and a higher numerator, and that's your signal to burn ratio. So you're going to be measured by that, and so you're going to have to show every dollar, and basically this is what that is in a nutshell. For every dollar invested, what are we producing? What do we get? So we put this money in and we get this. Okay, so if you got this really high numerator that says, okay, we put this money in and we get this huge product return and production, then the chances are it's going to be easier to get an investor and attract them. But know what else? You're going to have a higher valuation.
Right.
So we're looking at, and this signal to burn ratio is kind of the hallmark of capital efficiency. Okay, it's, in other words, those are the terms that they're going to use behind the scene when you're not in the room, and they're going to discuss that, and they're going to say, well, what is the capital efficiency? What is the length of the runway here? What is the signal to burn ratio? What do we think? How long, and basically in a nutshell, for us that are simple minded, how long is that money going to last before, right, and what are we going to get for it over a period of time? So with that, just kind of as a starter, where would you like to go from there?
Well, Kevin from Nashville wrote in a question, and I think it kind of applies here, which is, how much traction should a startup realistically have before approaching institutional investors? He says versus angels in his question. So, where do you have to get to before you're even having these conversations?
Well, that's a great conversation. I mean, that's a great question, and that's all over the board. it just really depends on the business that you're in, and it depends on the amount of capital we're talking about that it takes. And uh, look, a lot of folks have started businesses with very little money, and they've been able to prove that business out. Okay, so when you're doing your calculations and you're saying, okay, we're going to start this business, and I'm going to need $500,000 to be able to prove it out, or 100,000, or a million, or whatever it is. So if you're able to get that product out there and or get that business open and running with proof that it is in fact something that where there is a product demand, and that it can work and it is scalable, then you're going to have a great time raising money. You're going to get good valuations. You're going to be able to really build a national company because people are going. I mean, the investors are going to want to be part of that. So uh, it just depends on the business. I mean, if it's capital intensive, you're going to need a lot of money, and you might not be able to even get started. You might just be an idea. But look, if it's a great idea, and there are a lot of businesses, Dave, that have started with nothing but an idea.
Right.
And I think, I really believe that there will be a day when some of this AI stuff goes the other way. I noticed this morning that Bitcoin had dropped like 40% or some huge amount, right? People lost billions on that. I'm just telling you. And so I think the AI business might get crowded. I think it's fantastic right now, and we're seeing incredible things happening with AI. AI is doing so much to make our lives better and easier and whatnot. And so, but I do believe the space might get crowded, and there may be a day when we start to see that come down. But really, it's all about how much money does it take to get you up and operating, and then what is the scalability of it, and what is the long-term profitability of it. And when I look at some of this AI stuff where they put in $100 billion, 50 billion, 100 billion, $200 billion, I'm sitting there saying, wow, how is that ever going to give the return? And we talked about it last time we were on. I said, if a guy put $100 million in it and he owns less than 1%,
Right.
he owns like 0.003%, right?
Hard to get that return, as you said.
Man.
Lisa wrote in from San Francisco and said, when VCs talk about traction, there's that word again, what does that actually mean today? Revenue, users, engagement, or something else? You started to talk about that when you said, hey, we know ultimately, right, it all comes down to revenue.
Yeah, traction. You're selling product. You've proven it. It works. It's working. I've got a pilot product. I've got traction. It's happening. I can show you that it works. I can show you that people want this. I can show you product demand. I can, and traction can come in many different variations and many different ways. But if you got traction, you're going up the hill. It's working. You're biting into it, and you're making it go. And so it could come in, like I said, a lot of different ways. But basically, it's proved out that what it is that you're going to do can work.
Brian in Columbus, Ohio wrote in to info@scrushyonbusiness.com and said, in the current environment, Richard, are investors more focused on growth or profitability, and how do founders strike the right balance?
Wow. I think that depends on the investor. A lot of the investors, I mean, I've met investors that are not worried about short-term losses. They are looking, though, at that signal to burn ratio and the runway and their capital efficiency. They are thinking about that. But some businesses just are not going to be profitable for a period of time. I mean, it's just the way it is until you have enough traction. Okay. But I think they're looking at both. I mean, what is the long-term profitability? I mean, in one day it's got to make money. I mean, let me tell you, there are biological companies out there. It's a totally different animal. They're on the cutting edge of creating some new drug that will change the world. That could be that the pharmaceutical industry would pay $1 billion to own because they know this thing is going to be huge, right? They may spend 3 to 5 years, okay, losing money every day as they're doing the investigational work, as they're doing the research, as they're proving it. I talked to a guy recently who's got a product that is going through FDA, approval right now, and he said that they had done all of this work, and they came back and they said, "You need to inject this product under the skin of 500 rabbits, and we need the results of that."
Hmm.
And I said, 500 rabbits? Why not 100? I mean, wouldn't you like prove it in 100? I mean, 50? Why 500? But they wanted the results of 500 rabbits. Now you know who at the FDA is making those kind of decisions. I mean, why wouldn't it 150? I mean, really, what's the difference between 100 rabbits and 500 rabbits? But I'm just showing you, look how much money they had to spend just to do that, and to be able to get this through the FDA. So here goes more money, more burn. Right now, here's the good news: they did the 500 rabbits and didn't have any side effects. Okay, now the product can go ahead and get approved. Well, when the product gets approved through the FDA, now they can go out and tell the world, we have a product and it does these things, and it's FDA has signed off on it. Okay, so now we can go out and this can become $1 billion product, if you will. But they had to spend a lot of money and lose money for a long period of time until they got through all that process. So it just depends. You know, it depends on the situation. A lot of companies, a lot of businesses, they open up and they start making money immediately. You know, they're very successful. They got a huge product demand. They got a low cost of capital to be able to get there. But then you have those others that just take, you're going to have a long burn rate. But let me tell you this, they may have invested $50 million, but it might be, or 100 million or 200 million, but they got a multi-billion dollar product. So you see what I'm saying?
Yeah.
There's an investment community out there, institutional investors that fully understand biologics. They fully understand new drugs, and they invest in those knowing that there's a burn rate over a period of several years before they ever get it there.
Those are the types of insight you can get from Richard Scrushy. Info at scrushionbusiness.com. And we'll get back to your questions in just a minute. But first, I have a question, honest question for you guys out there. What do you do when you get ready for a first date? Would you get a new haircut, clean the car like you're picking up some royalty, probably overthink everything you're about to say? Well, let me give you one thing that's non-negotiable before a first date, and that is deodorant. And that's why I use Mando. Mando is whole body deodorant. It's safe to use everywhere. Pits, feet, thigh folds, even those hard to reach areas. We'll keep it family friendly here on this podcast. But what surprised me is how well it actually works. Mando was created by a doctor. Richard was just talking about people doing things that they know about. This was created by a doctor who saw that normal body odor was being misdiagnosed and mistreated. So instead of masking smells, Mando stops the odor before it even starts the odor. It's clinically proven to block odor all day and control it for up to 72 hours. They've got the solid deodorant stick. They have a spray deodorant, and all of it's baking soda and paraben free, which is important. And the results, they speak for themselves. 12 hours after a shower with soap alone, the average guy's odor level is a 5 out of 10. With Mando, 0 out of 10. Some men try to mask it with odor and heavy scents. This stuff smells great. Mando gets the job done right. Don't mask it, Mando it. Don't mask it. Mando it. You can find Mando at Walmart, Target, and retailers nationwide, or get the best deals at shopmando.com. And for a limited time, new customers get 20% off site-wide plus free shipping with our exclusive code SCRUSHY. That's shopmando.com. The code is SCRUSHY, SCRUSHY, for 20% off site-wide plus free shipping, shopmando.com. Please support the show. Tell them we sent you. Mando's got you covered with deodorant plus sweat control. Say goodbye to sweat stains and hello to long-lasting freshness. And we thank the folks at Mando for sponsoring today's episode. Let me get back into some questions here, Richard. We're going to go to Samantha in Denver, who asks, how do you prove the value of your product when you're early stage and you don't have meaningful revenue yet?
Pilots, a pilot product, find a customer that will use the product, if it's a product or a service. You're going to need someone that says this, we did this, or we use this, or we tried this. and it works, and it works well, and we really like it. And matter of fact, we're going to use more of it, and we're going to buy more of it, and we recommend it to everybody that's in our industry. They should try this product because here's what it does. So you've got to find a pilot customer, and you've got to document. And that really is where you have to go with it. And if you don't do that, and you can't do that, then you may not want to put your money in it. You've got to have some, and back to traction. That's traction.
Right.
If it works and you got somebody says it works and they're legitimate and you got a reference, you get two or three people that say it works and that we've used it. And then let me tell you, so you're talking to an investor and you're pitching your deal, and the investor may say, "Can I call him?" And you say, "Absolutely." You call up, you let them know that the investor may want to call them, and then the investor calls them and says, "Tell me about the use of this product or this service or whatever. How did it go, and what did you use it on, and what did it do, and why do you like it, and then how much of that do you think you'll use annually or monthly or daily or whatever, so that you'll be able to show that the need for it, and that's like saying, in the pizza business, every family is going to order one pizza a month, and there happens to be 100,000 homes in my area that I'm serving, okay? And we're going to get 10% of that business. You can calculate exactly how many pizzas you're going to sell that month. And then if you've got 20 people or 10 people that are using it and I'm just using that, pizza, it could be cleaner, it could be anything. But you put together a network of people that will say that this product is good. That's what you've got to do.
Bill Manovich, I would say go back and watch our episode with Billy. He did exactly what you said, right? He went into those hotels and he said, "Here, try this product so that I can test this out," right? And he couldn't get that appointment, couldn't get the opportunity to get in to pitch them. But when people actually had it in their hand and were using his product, he was able to now say to people, not only do they think it's a great product, they are looking at the value that it can bring in terms of saving money. We talked about that with the healthcare involved in taking care of their employees. Employee can't come in because they have a bad back, and now you're able to give them something that scrubs things that are down low without them having to bend down. So he had the best possible traction, if you will, which was putting the product in people's hands and saying, "Here, use it, and you tell me."
Yep, yep. That definitely gave him some traction. I was looking at deals. Oh, go ahead. You got another question? Then I've got something I want to add. Go ahead.
Okay. No, I was going to say the question that had come in from Heather from Minneapolis, and we can answer it or you can chime in. How much weight do investors put on the founder versus the product when deciding to invest?
I think it's just as much on the founder as it is the product. I think the management team and their ability to execute. Because let me tell you what I've seen, Dave. I've seen inferior businesses get funded because of the leadership and the team. I had a venture capitalist tell me one time, "I'm not impressed with what they're doing, but I'm impressed with what they can do." And that's what can that management team do. And if you've got, and so, for example, they'd say things like this: "That guy's experience is incredible. As a matter of fact, he worked for XYZ company. He was a senior executive. He started with them and they were 100 million. And when he left, they were 5 billion. He grew with that company. So he's got experience in scaling a business. He's got experience in managing a lot of people. He's got sales experience and development and product experience of moving product. And he understands production and yada, yada, yada." Okay. So they say, this guy, here's exactly, and I'm going to quote a venture capitalist. He said, "This guy, I don't know what he's going to do, but I know he's going to do it. And I know it will be successful because everything he's ever done in his life, he made it successful." Now he's pitching this business, and I'm not 100% sure that this is a great business that he's going into, but I'm going to invest in him because I know that he will figure out how to make it profitable. And so I saw that. And as a matter of fact, that business did become profitable. And in 4 years, they sold it for lots of money, and the investors all made, 6, 8, 10 times their money. So, it just depends. So I think that 90, if they don't, if most of the time, a very good CEO, a good visionary, a good entrepreneur is probably going to have a decent product. He's going to have something that he believes he can roll out. So I think his value many times is equal to the product. That would be my response to that.
Yeah, a lot of times they're deciding before you even get to the product, right? Because they're evaluating you, the founder, first most of the time, because that's what they're going to know uh,
Exactly.
more about. So, tell us what you were going to say about there. We have some questions about current, things going on in venture capital, but I know you had some insight.
Yeah. I just wanted to so I've been, as you know, for months, I've been studying the venture capital market and the deals that are being done, and I'm really interested in that. And so there was a report that came out, and the data came from PitchBook, Crunchbase, KMPG, and NVCA. It's a report, and basically they tallied up the annual global VC deals that were done over the last 5 years, and I just thought it was really something we should share on the show. And let me tell you, on a global basis, I mean worldwide, in 2021, and the reason I share this because you can kind of track what's going on in the world. There were 57,000 venture capital backed deals, okay, and that was the peak in 21. 2021 was the peak. Now I'm trying to think. COVID was when, Dave? What was that? 2021?
It's believed started in 20, right, and went into 21.
Can you believe that there were 57,000 deals that year in 21? That's the peak because in 22 the deals declined and there was only 43,000. And then in 23 it was 43,300, and then it went down even more into 24. Last 24 was 35,686. Now get this. In 25, there were only 24,000 deals. So
Hmm.
when you go back at the end of COVID or during COVID, 57,000 deals. Last year, 24,000. So you got to say, well, what's going on with that, right? So 21 was a high watermark. We saw a drop into 22, 23. They fell off further in 24, and then even more last year. But still, that's lots of deals that were done. So it was a total of about 203,000 venture capital backed companies were started over the last 5 years. So it'll be very interesting to track 26 and see if that comes up or see what happens. Now, what's interesting too is the market, has gone to an all-time high. Well, when the market have you noticed there are some sell-offs. Now, when there's sell-offs and people are pulling money out of the equity markets, they will many times put the money into the venture or into startup business, private equity investments, and other things. Because I mean, they're not spending that money; they're reinvesting it in somewhere else. But they take it out of the market for a reason and usually it's because they think this is kind of done. I'm done. I need to get out of here for a while. I'm gonna come over here and there's some opportunity. Sometimes they have to pull the money out over here so they have it to put in over here. And so we see that happening. Now, many of these companies that they're pulling this money out and putting over here are going to become public companies out here. And that's going to drive the market up because there's more valuation. And when we look at multi-billion dollar company, 100 billion, 200, 300 billion dollar valuations, that drives the market up. So the more of that you see, then the more you will. So that's kind of what's going on now. As this just a guy out here trying to start a business, what does this mean to me? It means that this money coming out of the market, okay, is going to go into potentially venture or startup deals or into investment funds. And so there is liquidity in those markets to invest in startup businesses. So if you have something that is solid and does work, and you've got leadership skills, and you put a team together that does all the things that we've talked about over the many shows, because you got to have the right team. You got to have people that are respected, people that can execute, and then you've got to focus on how much money takes me to where. In other words, we're back to the signal to burn ratio, right? To the runway, to the capital efficiency as we talk about. So putting it together in a format where X amount of dollars is going to produce a pretty big return for the investor. and it's a concept. Now, there again, there are things that are pretty simple that are they're not interested in.
Hmm.
It might be scalable, but the margins may not be big enough. So, so looking at some of the things that they are interested in, we talked about this the other day. We talked about the fintech, the building the financial stuff. We talked about healthcare tech, platforms that, to manage healthcare operations, whether it's doctors and hospitals and services and outpatient and all the different things. Those are things. AI continues to be a big thing. But I did read something recently that one of the analysts said that they're said to be very careful on the AI side because it could be getting crowded and we could see some reduction in that. So all of that is important. But and then believe it or not, climate. That's an area they're saying that is always is still opportunity for business deals. But when you start talking about I'm going to build a restaurant chain, okay, that's a whole different ballgame.
Hmm.
And there's so many restaurant chains right now where I live, I can't even go around and eat at all of them. I mean, and I had lunch the other day, my son and I, and it was $16 a piece. And I said, I'll never go back to that restaurant again. It's just too expensive. You don't want to run out and spend $16 for a sandwich and a drink. And so, I don't know. My thoughts on that is that I'm going to drive by there in the next year or so, and it's going to be closed. Does that make sense? I mean, you see what I'm saying?
No, it makes perfect sense. It does. And we'll get back to some more questions. I've got one
Go
coming
ahead.
that kind of hits on that subject here in just a second. But I know something we all have coming up, and that's spending some time watching television because it's Super Bowl 60 coming up on Sunday, and that deserves a sports book built for the moment. Our friends at DraftKings Sportsbook, an official sports betting partner of Super Bowl 60, puts you right in the center of the biggest game of the year. And when anything can happen during the Super Bowl, DraftKings has your back. We've told you before with early exit. If a player goes down in the first half, you still get paid out in cash immediately once your bet settles. No bonus bets, no waiting. Of course, we know Seattle is the 4.5 point favorite over New England, according to DraftKings. And they also have Sam Darnold currently as the favorite to win the MVP. There's so many different ways that you can get in on the action. You can bet all the different props. You can even bet on who might set a Super Bowl 60 record and so much more. Here is one that I like. I put a little on this. Seattle wide receiver Jackson Smith and Jigba. I say he gets the first touchdown in the game, plus 550. So there's my pick for you. If you're new to DraftKings, new customers can bet just $5 and get 300 in bonus bets if your bet wins. So download the DraftKings Sportsbook app now and use code Scrushy. That's code Scrushy, SCRUSHY, and turn $5 into 300 in bonus bets if your bet wins. This is in partnership with DraftKings, where the crown is yours. Gambling problem? Call 1-800-GAMBLER. New York, call 877-8-HOPE-NY or text HOPE-NY. Connecticut, call 888-789-7777 or visit ccpg.org. On behalf of Boot Hill Casino in Kansas, wager tax pass-through may apply in Illinois. 21 plus in most states, void in Ontario. Restrictions apply. Bet must win to receive bonus bets, which expire in 7 days. Minimum odds required. For additional terms and responsible gaming resources, see dkng.co/audio. And this is a limited time offer. We thank our friends at DraftKings and hope everybody has fun watching the game on Sunday. Richard Mark from Austin, Texas wrote in, and you just started to hit on this before I told everyone about DraftKings, which is over the last 5 years, which categories have attracted the most venture capital and which ones do you think are quietly falling out of favor?
Well, that's again, we got great listeners, great questions. Uh, I believe that, I mean, right now we're seeing this whole, AI and software, services. I mean, these are areas that right now are huge. Biologics are huge. New drugs are huge. All of that, anything that will help us live longer. I think we're going to see a whole longevity medicine sector that's going to evolve, and longevity clinics and longevity opportunities for people. People want to live longer. They want to be healthier. We're seeing all the introduction of all kind of treatments from peptides to, exosomes and stem cells and hormones and different things and we've got this whole weight loss industry going on right now. And there's certain things that are good and there's certain things that are bad. And some people are actually overdoing it and having some problems. But I believe that we're going to see more and more of that, and that's really a function of people that have extra money to spend. If you don't have the money, you're not going to be able to play in that. But I do believe that those areas are going to expand. We're going to see more and more technology in diagnostics in healthcare, surgical procedures. You're going to see that less intrusive, less invasive. There are new things that I am aware of, as a matter of fact, because I'm a healthcare background and people call me all the time. New procedures to treat back injuries, to treat all kinds of different things that people have, and including cancer and whatnot. So let me tell you, memory care is
Hmm.
huge. Memory care. I mean, this whole cognitive thing, improving cognitive function. How do we go about doing that? What can we do to make sure we don't have Alzheimer's? I mean, this is a huge area. So we're going to see more and more of that. And so I'm pretty excited about what's going on in the healthcare industry. And then again, the new drugs, new biologics, things like this, and all kind of new products are on the horizon right now.
What do you think about the other direction of things that may not get as much attention here over the next few years while everybody is putting all their money into technology?
I think that this is the basics that we have to have. I mean, things that used to be important, uh, I mean, we're seeing, of course, in the auto industry, we're seeing some really neat stuff coming out in terms of design and whatnot. But I think that just your routine stuff that we buy, and our retail stores across the country are less interested in invested in those. I mean, you got the WalMarts that have just like blown everybody else out, but I think the mundane things that are essential, that are important, are receiving less. I mean, nobody. I mean, you don't see a lot of venture capital going into the clothing business. I want to invest in a new line of clothing for men or women or whatnot. I think a lot of that is being funded by angel investors and individual families and whatnot and existing companies. But let me give that some thought. Maybe we talk about that next time. But because right now the young MBA fund managers out there that are in their late 20s, early 30s that are managing billions of dollars, which I've met with them many times, they're looking for the things that can explode, that have huge, huge opportunities where they can build multi-billion-dollar companies in a short period of time. Let me hit you with this. There are a few things you don't want to do. If you're pitching a deal or you're putting a deal, what you don't want to do is overdo your metrics and downloads and impressions, and you put all this stuff out there, but you don't show how it's going to convert into dollars. So if your vision is too big and you explode with your deck presentation and you just got a whole bunch of stuff in there that they can't follow, that's a no-no. And you don't want to over engineer your what your product can do, and in reality it can't do all those things, but you made up all this. Be careful with buzzwords. Be careful with how you're going to use AI and blockchain and all of that. Make sure, because some of these investors are really smart and
Hmm.
they understand all of that. And if you get out there and make a lot of claims, you can get in trouble. But the things you do want to do is you want to have clean metrics. You want to be very clean. Your metrics have got to be clean and understandable, quickly to understand is what I want to say. Your story needs to be fairly simple so that you need to show the problem, the solution, and the traction, and why you're going to win in building this business. So efficient progress relative to the capital spent, because that's what that whole signal to burn is. They're looking at, what is the product per dollar burned? What do we get for each dollar? So, those are things that you need to focus on and make sure you're able to present really well. And so I'm saying that because, and this is serious stuff, Dave. If you're going to go out and take the time to pitch and try and raise money, make sure that you engineer your presentation so that comes across. Does that make sense? I just want to help people out there and tell them, don't come in with a bunch of bull. It
Yeah,
needs to be,
you won't get far.
no.
You
What's
will
your name?
not.
You got
Here's a
another
good
one?
one from Tony in Chicago that we can finish on this week that asks Richard, for founders outside Silicon Valley, how important is geography when raising venture capital in 2026?
I think it's very important. It always is. And I'm not 100% sure what he's asking, but I think, are you talking about where your businesses are going to be located, what the demographics are? Um, Geography, I would think, is taken into, what are the locations, what are the cities, what are the states, how big can you build this? I've always said that if you're going to raise venture capital, you need to show that this business is a national, at least a national, if not international opportunity. It's bigger than your local market. And if it's just a local market or even a regional, it's not going to work. One of the first things that I learned in building Health South Corporation was we had to get outside of our local market to prove that our success in our local market wasn't that's the only place we're going to be successful because we knew the doctors and we knew the people, and therefore it was going to work because we had relationships. But when I went to Baltimore out of Birmingham, and I went to Miami, and I went to Denver, Colorado, you see what I'm saying? Then in St. Louis, things began to change, and they said, "Oh my gosh, Little Rock." And they said, "Why you go to Little Rock?" And I said, "Because if we made a mistake, nobody probably ever go see it." But anyways, that was a joke, and because it was not a destination, and that of course the venture capitalist said that to me, and he said, "I'm going to Little Rock and I'm going to see it," and I said, "Little Rock's a beautiful town. You need to go there. It's great, right?" But we had a hard time until we expanded it outside of our local market and we went to Baltimore and we had a very successful location in Baltimore, and Miami was killing it. And so when they saw that, the money came in. They said, "Hey, this thing can go anywhere." So geography, yeah, it is important. It really is.
Well, that's going to do it for our weekly episode of Scrushy on Business. A lot of good information. And we also want to remind you that there's plenty of other episodes that we have recorded and talked about. Bill Manovich in the episode we had, some guests that we talked to earlier on and have answered a lot of questions about venture capital and how to get your business started. And we always appreciate everybody joining in on the fun by emailing info@scrushyonbusiness.com, because you can ask these questions directly to Richard. And Richard, I'll let you have the final word for this week.
Yep. We just appreciate the viewers, and we have added some new viewers over the last few weeks. And we missed a couple of weeks. We had the Christmas time off, and then we had the storm, and we couldn't get together to do this, and so we apologize to those of you that are looking for, us every week. But we're gonna, if it's possible, we'll have one out every week. And we appreciate your viewing, and ask your friends to take a look. And it might be some things that we do that interest them. We hope you're enjoying it, and do let us know if you have any questions or any thoughts or any recommendations. We're wide open, and we do appreciate you.
This
Thank
show
you.
is for you. So if you have those questions, get them in info@scrushyonbusiness.com. Well, that's going to do it for this week. We will see you next week on Scrushy on Business.